Today, we're focusing on the writing of the strategy and mandatory climate reporting, as well as going on the last few slides on the costs of mandatory climate reporting, which is something that normally CFOs or sustainability managers building the case for the resources allocations for climate reporting, or even consultants trying to pitch this work is really, really insightful. Okay, but feel free to interrupt me at any point. All right, just as a reminder, this is the last session of our climate reporting series. If you haven't attended the other sessions, they are live on YouTube, and we're trying to make those slides available as well. And I want to take this moment to really thank every of the experts that join us at different sessions, all great partners of NetNada, and it wouldn't be possible without them supporting us. So really excited to partner with these fantastic people that explain the readiness assessment, governance, and as well as climate targets and metrics. Today's agenda will look a bit at bringing back the NetNada Research Report that we've done last year and the relevance of it today. We're going to understand the strategy pillar, and we are going to walk through the legislation as well as using examples. And then at the end, happy to do Q&A, but feel free to interrupt me as I go. And we'll touch on the pricing of climate reporting, what the government and Treasury have put out in the past versus what we're seeing, and the potential discount for Group 2 companies coming into effect this financial period. Using Zoom, everyone knows, but just as a reminder, feel free to use the Q&A or the chat. And I'm going to deep dive straight into the NetNada Research Report. The reason why this is relevant, last year we've conducted a series of interviews and surveys, and it showcased that strategy was the lacking pillar of how sustainability professionals felt about their sustainability journey, as well as consultants supporting those reporting companies. And I think with the 60 odd reports that we've reviewed so far, it does seem that strategy is the missing link, or companies are not connecting the dots as well as they could. We're doing this exercise of reviewing climate disclosures ongoing, and we're compiling a database of those. So if you want access to that, just do let me know. One hypothesis of why this is happening is because boards or executives are not being upskilled as soon or as in-depth as they should be, which means when sustainability managers or people involved in the reporting try to link everything back into a strategy, it struggles to get approval on that last bit or last mile, which means you have to kind of simplify it or dumb it down or reduce the commitments, or really not showing how interlinked everything is with one another. That's a hypothesis. Of course, we have to test against that, but it kind of showcases what was happening when we did our research and what is happening now. As well, just a reminder of like the insights from first reporters. This is not really linked to strategy itself, but as a reminder that this report can be embedded into an annual report of a company or can be a standalone, as well as that the range in the maturity of what we see in the reports really differs. Especially a good metric is like the number of pages. It goes all the way from 11 to 83 when it comes to your sustainability report. One thing that was brought up in a conversation with a client last week, and in a presentation we've done to a group of CFOs as part of a private equity, is that Group 1 companies had all this money, so that's why they can make these long reports. Length of report and availability of resources doesn't translate to transparency. We've seen a lot of reports from large companies that really don't show good transparency or good usability when it comes to reporting. Just opening the chat. If you do have any questions, please do let me know. Now we're moving on to the strategy disclosure itself. If anything on those intro slides was not clear, feel free to interrupt. The disclosure under the strategy pillar, we want to know the what, the who, and the how. And this is kind of the common theme, across the whole legislation, across the whole AASB S2. But if you've done your metrics and targets, if you've done your climate risks and opportunities, if you've mapped your governance, the strategy is grabbing all those bits and creating a plan on how you really are tracking these things, and how you show that is now business as usual on how the company operates and what they aim to improve over time when it comes to their resilience to climate change. We have a question coming in. I'm just going to read that out. Does the length of the report only covers the climate section or across all ESG topics? This is the length of the report when it comes to covering the AASB S2 legislation, and is divided in the reports as being so. So this is just to cover the topics mentioned in the legislation itself. How to create a climate transition plan. Now, first, we need to understand that this is the entity's overall strategy, and it should cover all the things that have been done previously in the report. It is hard to do the strategy first without doing the other things, but you might read existing reports and understand how people are linking things together and try to visualize the end goal and then walk backwards from that. Same thing with like your ambition level. This is something that you can do. When we've done the report in 2025, we saw that 28% of companies had assessed the financial impact of climate risk opportunities, but they didn't do the step to do a formal climate transition plan on how they were going to mitigate or reduce those risk opportunities over time. This is the gap that I was trying to explain a bit earlier. You need to demonstrate proactive climate action, and I'll show a couple examples, not only to meet these legal and regulatory reporting requirements. If you remember the previous sessions, this is about the transition risks, but also how do you become a more valuable business over time, and that your revenue opportunities are not impacted by these changes. There are five main components of the strategy, and we're going to go in deep dive into each one. If there's too much text on screen, we'll have the slides afterwards, but you can read as I go. We're going to cover the business model and value chain with examples, the how to do the decision making, climate resilience, the financial position if you're able to do so, and then how you link the climate risks and opportunities, and a bit of a refresher from the previous sessions. We call it like a foolproof climate transition plan. Has to have a couple of things. I want to have or emphasize two main things. One is the how clear the objectives and targets are, like what you're actually tracking. And these things don't have to be only tracking emissions. You could be tracking the reduction of an occurrence of a risk. It could be how often a heat wave impacts your workers. Okay, it's not related to emissions; it's actually related to a climate risk. And then, of course, you have to see how you're going to track that today, and then if you're going to improve your processes, or you have a goal for your medium and long-term milestones. That's one thing I want to focus on. The second thing is that resourcing and funding. It is really hard to believe that a company is going to change how things are done, or they're going to add all these new capabilities into their operations without the allocation of staff or resources or money behind it. So we expect to see companies showcasing how their team is going to be constructed, what technology they're going to invest in, what data sets they're going to buy, or how they're going to build resilience over time. If you're setting all these new things that your company didn't do before in this report, it is expected that you have a team or resources to match that. If not, it's not really worth the paper it's written on. On the back of that, to make this happen, we expect stakeholder engagement. We expect that the company not only looked internally to what they want to achieve, but went out to their value chain and asked the same questions. A climate transition plan, and you can screenshot this slide, should be clear and actionable, things that you could try and do over and over again. It should be aligned with the overall business strategy. If you're in your financial strategy outside sustainability, you're saying that you're gonna increase portfolio value, or you're gonna go and enter this market that is actually exposed to climate change, and then in your transition plan you're saying you're gonna divest from that, it doesn't really line up. So we need to make sure that things talk to each other. It needs to be future focused. We expect, when you're looking at climate reduction opportunities, to look back at things that happened in the past and what exposed your company, but also, of course, looking how it shapes in the future. And then the best practices is that it is quantifiable. This is not only on emissions, but like I was saying, on risks, on opportunities, on things that you want to achieve over time. It should not be, and we have templates and you can look at other reports, but you should tailor this template of what the transition plan might be into your own company business strategy. Hopefully it is committal, which means if you just say you're going to improve not really a metric. We want to understand improve by how much, the quantity, or the expectations that you are going to achieve. Same thing as you would do with anything inside your business. And also it needs to account for short-term and long-term adaptation. What I mean by that is that we expect things to happen today if they're material, but also how you build the capability over time. This is a small screenshot from an organization in the energy space. This is just a snapshot of what could be one-page representation of things that you want to achieve. And of course, behind this, you need like the methodology and the text. But you can see the different reduction in the carbonization over time. All the metrics that are not linked to emissions, for example, assets installed or demand side flexibility, and of course, other higher metrics. For example, it's a number one in commercial solar. A target could be, we want to stay number one, and of course you have to explain what number one is, but this is just to showcase that there are more metrics than just emissions when going through that. All right. I just have a question from the chat. How important it is to have the formal climate transition plan assured by a third party? That transition plan does not need to be assured in the first place. And it can be the same auditor of the S2 report as it's part of the report, but on the first year, you don't have to get your transition plan audited. Hope that answers your question, but to summarize, it can be the same auditor. When talking strategy, and this is just a bit of a refresher because it sets the foundation of the whole report, is these risk and opportunities. We just want to understand how it reasonably affects your business, like was mentioned in the past, and that you go over that physical and transition risks, that you have the industry context, might be your association that has some information for you to share, might be boards that see the multiple businesses, might be by looking at your competitive landscape, but also that you understand if you're operating in Australia and what's the impact from that, from like a risk and opportunities, but also if you have business overseas, that you also look at that if they are a material in terms of revenue generation. Then, as mentioned before, when doing these risk and opportunities, you have to look at your short, medium, and long-term horizons. And that might really depend the strategy that you implement today versus in the future. There are recommendations in terms of what those horizons might be. 1 to 3 years for the short term is a good example. Then the long term is 10 years plus. But you might align these horizons with how your business operates from a financial sense. You might change or redo your strategy every 2 years. So we expect the short term to be on that second year as well. You can look at your competitors or at your industry of Group 1 reporters and understand how they set those time horizons and use that as your explanation. But it might also be easier to align these horizons with your own business strategy on how you make certain investments, or how often you create new lines of businesses, or how ready you are to invest or divest in an area of your operations. When looking at these climate risk opportunities, if you've done a workshop, as an example, with NetNada or a consultant, and you're bringing that data in, you're looking at past events, current conditions as your business is today, and future forecasts. I've highlighted here the without undue cost or effort. This is the way that the legislation has communicated that some things might be hard to do, and therefore you don't have to do them if you don't want to, and you are not expected by your stakeholders or your investors to do so. Might be that you have 30 properties, 30 assets, and you only hire a consultant to look at your exposure to flood on 5 sites, not every single site, because those 5 sites are the most material in terms of like revenue generation or the value of those assets. Okay, and you might rather know that you've carried on an in-depth expert consultation and analysis on the flood risk of certain assets, but only represents 80% of the portfolio, not the 100%. So that's language that you can use to showcase where certain things you didn't go all in or you didn't invest more time into it. Is this undue cost or effort clause, and it's ambiguous to start with. So your explanation here is benchmarking on peers, but also resources availability. This is here the kind of the extract of the legislation that I'm talking about. Any questions on that? As a brief pause. No questions so far on the first section. Perfect. We're flying through. Now into the business model and value chain. This is more like to bring everything together. And what I'm showing here is an example from Pepper Money, which is a Group 1 reporter that has a really good report. It's a company that disclosed almost no material climate risks and opportunities to begin with in the short term. However, they didn't say no, they didn't have it. They explain why they didn't, which might be a really good example for maybe a professional service company that is now in Group 2 that wants to that done the analysis, but actually nothing is really material to take action today. This explains, it's a good report to see how they've built a narrative in the analysis that they've done across all the pillars. This is an example of a business value chain. You should have one for your business. If not, you can do that via a stakeholder engagement, but it really like defines your upstream value chain, your downstream value chain, and the core business activities. All of these stakeholders should be present when present, like either in the room or while we run the assessment, or as a consideration when you share your opinion about certain things during workshops or while setting targets, because they all kind of impact how your business is done. Your regulators might come less often into conversation because they've already set up the rules, but maybe you are in the packaging industry or manufacturing industry, and new regulation in terms of like waste and packaging is relevant to you, or circular economy programs in that industry, or if you're in the food and health, what are legislations for like transparency on labeling. So all these things are what you want to kind of be bringing together as you build this. Perfect. All right. Now, how do climate risks and opportunities affect or currently affect and potentially affect your business model and value chain? It depends on the business, of course, but we are adding here 4 key considerations that you might take into your business and always check. So scope of impact, this short-term and long-term again, the operational shifts. So is it changing the cost structure? Is it changing how often you can make business? Is it changing how efficient you are making business? So this is something to have in the back of your mind. Growth and development, maybe it's not something that's happening today on how you make business, but the future of it. Here we give the example of transitioning to a greener product and services, greener being more sustainable, more climate friendly, lower carbon footprint, more recyclable. You might run the analysis that there is business opportunity to do so. You need to invest into R&D to launch a new product, to capture a new segment of the market, because there's demand for that. And of course, that internal and external factors that might not only happen to you, but within your supply chain, and how they are changing their practices and the products that they are offering. Where in your business, this is just coming back to this slide, is you might identify that some hotspots in different parts of the business. It might not apply to everything at once, and you get to decide or be transparent about where each impact occurs to which stakeholder. Again, it's about the hotspots, asset risks in terms of physical assets, but also supplier specific impacts, and of course down the supply chain, either upstream or downstream, there might be a lot of dependencies in your business. And if a whole sector of your supply chain or area of your supply chain is changing business practices, you might want to be a participant on that, co-invest, do be part of a committee, do workshops, or you might just sit and see what happens. But you might get to influence how fast things changes. A good example is, let's say you sell to Microsoft, either a hardware product or you're selling like professional services. You are expected to meet now new supplier criteria, and you can either just answer the request or you can get involved in how Microsoft is doing those requests, the webinars they organize, the supplier meetups, like all of these things. You might have an opportunity to impact your supply chain and then take those learnings and apply it to yours as well. This is a lot of information on screen at the moment, but this is a way that you could represent all of these things in a concise way, if you can call this concise. But a simple table will do the job. You don't have to go into like graphics and illustrations, but listing out the items that you've captured during your risk and opportunities workshops, the details of the before and after the adaptation, if you deployed any adaptation, and then the mitigation of those efforts. Each different risk might have a different way you are adapting or mitigating or capturing, if it's an opportunity, the value of it, or you might be able to combine those. So for a specific mitigation effort, you might capture 3 risks as an example, or vice versa. So it doesn't have to be a one-to-one match at all times. Perfect. We have another question in the chat here, which is the climate transition plan essentially the entire AASB S2 report, since it seems to encompass all 4 pillars of AASB S2? No, so the strategy component is a different section of your report. What I mean by that is it's not that strategy is sprinkled on different requirements or paragraphs of the legislation. Okay, so it's a different part of the AASB S2. However, you could describe part of your strategy as you go through the other pillars. As an example, if you answer a requirement for risk, you might talk about that risk and the strategy. However, you have to go through this and really think about the readability of your report and how easy it will be for your auditor when time comes to audit this information. You might want to reiterate some of the things to then explain and expand on the strategy of it under a different header. A good example is the report of the University of Sydney has a clear heading for strategy, and they go through the requirements there. And it's 4 pages of just strategy. You can take implementation, or in Pepper Money is a bit more all over the shop and explain as you go to the different pillars. I hope that answered your question. It's a really good question. There is no right answer. In practice, I might encourage for you to have a different section for strategy, so you really kind of tick the box on every paragraph. Really good question. Strategic decision making. This is just your plans that you have in place or will put in place to respond to these factors. And this, of course, you are expected to have the resources behind that and the ownership and the governance to make this happen. Either understanding how in the past your business has adapted to a change and showcase how you can be flexible as a business, or how you're going to prepare to adapt into the future. There's some key considerations. And again, back to just a quick side note, I'm listing here the number of the paragraph in the legislation if you want to kind of go through those while building the report. But just so you know that everything that I'm saying here is backed by that, bit of boring paper of legislation. Some key considerations while showcasing or answering these questions is, are you going to adjust your business model? Is there a direct mitigation adaptation? Are you going to change processes, change facilities, invest in technology? A good example is you want to reduce the energy consumption or increase the efficiency of a building that you own or manage. Are you going to upgrade the HVAC system? Are you going to upgrade the windows? Or if you're building a new asset, are you going to improve the quality of the windows or the orientation of the building to reduce the need to heating or cooling, as an example? These are the things that you expect to consider if you are in that industry. If you are in logistics and you have a certain fleet, what is your decision-making process to the next vehicle that you buy that is going to be hydrogen or EV, or you're going to change the route, or you're going to do maintenance more often? This is what are we expecting to see. The climate transition plan is kind of the main heading, outline your transition plan. This is kind of bringing everything together. And then, of course, showcasing how you're going to be achieving those targets. We encourage people to set a target. Hopefully, it's a target that you can manage and own. A good example is it is easier to manage your Scope 2 target because you might do investments in your own assets. You might have warehouses that you can actually put solar on, as an example, or invest in energy efficiency measures, while it'll be a bit more challenging to kind of own fully your Scope 3 target. If you want to set a target for Scope 3, maybe it's a part or a category of Scope 3, might be just employee commute or travel or certain suppliers within that particular services. That's the granularity that will help you make targets more tangible. Perfect. This is what I was saying before. Resource allocation. We want to see the training, the capital expenditure, how much money behind your strategy. Of course, you don't have to showcase sensitive information if you don't want to, but we're expecting some numbers behind it if possible. Look at how different teams are going to cooperate. Is it going to be a FTE, 2 FTEs, a whole new team, or just new responsibilities within different departments, and the long-term commitment and how you showcase that. This is an example of, I made up capital allocation for a climate strategy. Of course, they're big numbers. We're talking billions. A Group 2 company wouldn't invest billions on their climate strategy. But it's just to showcase that, we want to see the size of your fund, the size of your R&D, the size of your team to really show that you are have the resources to achieve your targets. Finally is over time, after year 1, you maybe already set how you're going to track those targets or those measures, or you're going to bring it in year 2, but do we expect to see those progress updates on the same cycle that you do business updates? We expect to see, implementation of KPIs and metrics over time, and hopefully we'll see continuous improvement, maybe not on the targets itself, but the reduction of risk over time as a business. Any questions on that? This is about, like I said, showing the resources and the numbers behind your strategy. And if you look at the first things that I covered is on the back of the hotspots, on the back of the value chain mapping, and of course, on the back of your risks and opportunities. We do have a question coming through, which isn't capital allocation again an aspirational thing that you just showed? This is an example that we made up. It's not coming from a report itself, but you can look into things like the current Group 1 companies. There's a few that have really good, concise capital allocation that I can share afterwards. If you make these statements in the next year report, you're expected to explain if you did invest the money or not, and if you didn't, what happened and why. The financial position in the first year, you don't have to show numbers or financial information when it comes to the impact of the recent opportunities. If you don't have to, it can be just qualitative when you do your materiality. However, we do expect companies to move for that financial impact, and people like ourselves and our partners, we are going to these reports, and it's really easy to see when you've done, certain description of a portfolio that you are overly invested in oil and gas, but then in your transition plan on your sustainability section, you actually didn't surface those risks or that exposure. So make sure that you really think about the business model and what you're doing. And even if you don't show the numbers, showcase if it's actually a risk or there's exposure to some of these short-term, medium-term, and long-term effects. The quantitative data will eventually make better reports. It's more expensive to get, and it's expensive to kind of trust those numbers to put them out there, but that's where companies are moving over time. Key considerations on this is that assets and liability adjustments. This could be not only if you own physical assets, but inventory, product lines, supply chain agreements. The physical impacts that can actually disrupt. These are acute extreme weather events that can disrupt your supply chains or how your customers buy, and how much money they have available to buy from you. But on the other hand, it could be an opportunity if you do roadworks, if you support in certain situations, if you're selling, discounted lines of clothing, maybe if there is more stress in a certain demographic from extreme weather events, it becomes an opportunity for you as well. And of course, the transition costs to go into a low carbon economy, as government has stated, or doing the divestments for certain areas that are exposed to things like, carbon credits programs, or just legal risks that you don't want to be kind of invested in. The same thing when looking at like these performance and cash flows. Remember, taking a step back, the main objective of this report is not to show how sustainable companies are. It is to show how resilient and the financial impact of climate-related matters in those companies. So the more financial you can be, the more number-based you can be, the better. That's what investors want to analyze and how they're going to allocate their money as time goes on. We want to see revenue from climate-related products, if available, and if it's material for your company, cost increases, if any, and of course the long-term profitability. Those are like the three metrics that investors would want to have at their fingertips. And in terms of anticipation, right, things that will happen in the future, continue on that. Capital expenditures, if you have to buy new assets to make something happen. Cash flow, if there is an extreme weather event and you have to deploy cash to be able to continue to operate or to re-upgrade or maintain or rebuild certain assets or certain supply chain links or certain customer segments. And like we were saying, the new revenue streams and savings. Now, on the same topic, I just want to reiterate that meaning of like quantitative and qualitative data. When quantitative information is available, you can separate it to just be qualitative. Now, this should be focused on the affected financial line items, the totals and the subtotals of the financial statements. You don't have to express those, but you want to showcase what was the reason behind not showcasing the availability or the materiality of those things. Might be that it is not material because you run the numbers internally, and so you don't decide to publish them. When possible, we want to see them combined as best practice, and we'll see this in year 2 and 3 of reporting companies. We want to disclose the combined financial effects of multiple climate-related risks and other factors together, if it's easier for you, but hopefully you see them break down over time. Any questions on that? Now, I've kind of glanced over the financial area of the report because most companies won't report numbers in the first year. But if you want to be kind of setting the standard, you want to be ahead of the curve, I highly encourage to disclose some numbers whenever possible. Lastly, just climate resilience is the word that you should be focusing on. It is not about sustainability. It's about how resilient your business is to climate-related matters, and that's the language that you should be communicating with your clients or with your stakeholders or with your executives and boards. Key considerations that we want to see is implication on strategy, the uncertainty or how confident you are in the things that you're saying, how adaptable you be, and the existing resources that are available. Moving on, that's a scenario selection, which you've done in the past. Refer back to the old or to the previous sessions. Why did you pick certain scenarios? Are they diverse? Do they follow the international standards and also what your competitors are doing? Time horizons and the key assumptions. This is something, as I was mentioning before, that you might reiterate in the section of strategy of the report, how you've done certain stuff, or it might be embedded when you're already talking about your scenario analysis, how you've done that process. Okay? You can either do it separately or while explaining the scenario analysis to begin with. This is an example of scenario of picking scenarios for a scenario analysis. You only have to pick two, and you can do, you have to pick your best case scenario and then pick one from the other three. You want to explain to your reader, if they don't have the information, what each scenario means. You don't have to make up these scenarios. Those scenarios are available to you for choosing, and your consultant, NetNada, whoever you pick, will be able to assist you on the selection of the scenarios. Insufficient action in here, just so you know, we're mentioning about the world in general not investing enough money and resources to tackle climate change. That's what it means. It doesn't mean your company in particular when it comes to the impacts of climate change, okay? This is global impacts and what then happens to temperatures, extreme weather events, etc. In the fast action or like lower temperatures, we're also seeing here it's not only about physical, but there might be extra laws that prevent companies to continue to emit CO2 as an example. And so you have to, not only temperatures don't change as much and there's not as extreme of weather events, but there's now also new regulations that kind of led to that, which means you have to be aware of changing customer preferences, different government contracts, more compliance costs, etc. Any questions on that? All right, we're going to the last section now. We're going to go into the costs. Okay. This is representing not only from the Treasury statement, but I hope that by looking at this cost, once again, if you've never read through the document, you understand the magnitude for some of the companies of how much money it is representing. We're also going to talk about proposals that we see, and then the discount on group 2 companies that we expect to see over time. So this is the table, adaptation of the table of the Treasury document when it comes to the cost of reporting in year 1 and the ongoing annual cost of reporting. Okay, there's a few assumptions here that we should pay attention to. One, they assume that there is no familiarization and education costs on ongoing. My hypothesis is that I don't believe that is true, because there will be team rotation, there'll be maintenance. Example, if you have a learning and management system in your company, there's a cost to that. So if you're adding sustainability or climate modules into there, the same thing. If you're doing like an annual skills refresher and you have to bring in consultants to come and do a workshop or deliver modules, there's a cost to that as well. So I would assume that there will be an ongoing annual cost for education as well. Now, the system changes, which will be kind of where some of the software costs are for the information flow. This might be your license plus changing. There's also assumption that the ongoing, there is no cost. I think because the ambition level of companies will change, they want more granularity, more supply-specific information. I also believe that those costs might occur in the ongoing part of the budget. Now, you see here that there is no drop in terms of like data collection over time. I think this might be a balance between the system changes and data collection. If data collection is broken down into like wages of your internal team, plus a consultant that's helping you out, plus a software, you might see a reduction as you operationalize some of these costs, even if the amount of information that you gather changes. Scenario analysis, it is expected to drop over time, which means you've done your first workshops in year 1, you've done the scenario, you've picked it. In the year 2, you might just review your kind of risk and opportunities matrix. What are the risks involved in that? How you're tracking it? you might not have to like redo or have all that time in person to do it again. Scope 3 modeling. The year one cost to year two is a bit confusing, meaning most companies might just be doing an assessment of the scope 3, but not reporting on it. However, as ambition changes, I would imagine that the scope 3 cost might increase in the ongoing years as you want to move from like spend data to actually activity data. So you're going from just spending, how much you spend on flights or how much did you spend on this particular supplier. You'll go through the effort of asking for quantities, volumes, fuels, etc. Preparation of climate reports, same thing. There is an expected reduction on year two. My hypothesis is as the ambition level and as the assurance increases, yes, you're going to pay more for assurance for different parts of the reporting, but the same thing will be seen in what you write in your report. And I think there'll be more due diligence going through the process. So I don't know if the cost of writing the climate report might go down as fast. However, we have that hypothesis that also technology, AI will help with collecting this data, bringing it all together, drafting it, stakeholder communication for approval, and so forth. The increase in this cost from year 1 to 2 on assurance is because there's now more sections of the report that need to be assured as years go on. To this price, there's this hypothesis, again, I'm saying this over and over again, of a 20% transition discount from where you start in year 1 and where you go in year 2. I expect a 20 to 50% drop as well in the cost from Group 1 to Group 2. So this $1.3 million we see here is your Group 1 companies, which from what we see is not that far off, not from actually what's happening in real life. Why? Because we're seeing that consultants might be charging all in all a package end-to-end for Group 1 who are skewing the number up because they're large into like $300,000 to $400,000 consulting fees, plus your internal ongoing costs of your sustainability managers, some of your CFO, your data analysts, and then the assurance and back and forth, the man hours. It can go up to that. However, for smaller Group 1s and Group 2s, we expect, all in all to only add up to like $500,000 in terms of costs. Okay, so it'll be kind of 30% off of the year 2. This includes paying $150,000 for like an external consultant, on top of having like softwares, on top of your $150,000 to $200,000 salary of the people involved with this process. Any questions on these assumptions of what I explained in terms of costs? Does anyone agree or disagree, or is seeing something else in the market? Perfect. Now, so the question is, is this the analysis of overall spend? Correct. This is the analysis of overall spend on the reporting, not just the external fees. This is including the internal cost of the company to report on AASB S2. How to buy? When you're going to market to pick your provider, your solution provider, your consultant, I think there's 3 options you should consider. Okay, especially when talking about like softwares and systems like NetNada. You have the option of doing it yourself. This is, you have an experienced team who's already been upskilled, maybe it's the second time they're doing it, and you want a software to, operationalize some of these data quality, some of like data gathering, the reporting, the consolidation of the information, and stakeholder communication. This might not be the case for most of the companies. Then we have the do it with you. Do it with you means you actually have a team, it's sustainability manager, plus an analyst, plus a consultant, and your CFO is on board, as an example. And in this case, you might also buy the software, but you want someone to help clean the data with you, someone to actually run 1 or 2 workshops, and also help you collate part of the reports that you don't have much confidence in. This might be having someone in your corner situation. As a sustainability manager, you want someone you can like bounce ideas with. You want someone on a retainer. You want someone who can like get their hands dirty. And then you have the do it for you. Do it for you you also have that involvement, but you're offloading some of the responsibility for someone to gather information about competitors, about expectations, drafting, and you are approving and kind of probing what's coming and landing on your desk, and getting like that ticked off. It's kind of fully managed service. These are kind of the three options, and I think there's not really a mix of those. Like, you can either do it all on your own, you just want a system and your team will manage it, or the do it with you might be that you purchase services externally when it's needed, and then do it for you is your full blown, AASB proposal, everything included. By understanding this, when you do go to market, then you can like differentiate how you're getting pitched, and also have run a better tender process or exploring better options for you in your business as you do so. The same thing is, if you've never done part of the disclosure and you're asking for a quote externally to help you with AASB S2, it is hard for service providers and consultants to quote you, and you'll bear the extra cost by not allowing them to first come in, let's say as a service provider, understand your business before quoting the whole thing, because they want to protect for unforeseen work, and so they overcharge you while doing so. For example, NetNada can either quote for the whole thing, or we can just sell the software, go in, understand your business, and then propose that we do the workshops, or we do help with the report, or we help with governance, upskilling, and education. So there's a couple of differences, and depending how fast you want to get budget approval, it impacts how you're getting pitched and sold to. One thing that I also recommend as we wrap up is comparing reports. Go online and find reports of industries that you care about or are similar to you. But we also have a tool available to compare reports that you can browse, see the different sections, download the reports, open it in your AI software of choice, and kind of run questions. This is something that I encourage everyone, either from sustainability providers to sustainability managers and CFOs, to understand how these things are happening. Get familiarized with how things look and feel. Draw your own opinion if something is easy to understand or not. And if it's not, expect someone that's reading the report to have even less understanding and less context about sustainability and climate reporting. So make sure that the language that you use is something that your peers that have not been fully embedded into the work can also understand. Don't be overly technical. That's kind of like the end of it. I can go back to the cost if needed, and there's like 10 minutes to go. But I just want to address that 2 main points. Strategy is the thing that links the whole report together, and you can either write it in a different section or sprinkle it as you go through the different pillars of AASB S2. And then at the costs really are material, and you need to build these case studies, and don't fall into the fallacy of having in what's called in project management the optimism bias, where your company is different and that you're going to be able to do it cheaper and faster. Most likely that won't eventuate. So the best thing you can do is to benchmark yourself against the real cost of what's happening in the market. And it might be by asking a service provider like us to understand how we're quoting, or what the Treasury estimate might be, which of course might be conservative by nature, but understand that also kind of relates to the ambition level that they expect for those companies. You might be the exception that assurance costs drop in year 2 because your process is impeccable, or it might be the one that like scope 3 actually becomes cheaper, or the analysis becomes cheaper in year 2. But most likely you won't, so make sure you plan and budget for that. Any questions on this? We have a question coming through. So the process of doing it with you, does it mean the use of the platform and with the help of account manager going through the process? How does that impact the price? Yes. So the price of, for example, NetNada, you can have a subscription fee. The subscription fee also takes into account implementation and ongoing support. But also you might have the request to do data cleaning with us, or actually jumping and doing workshops in person with us for climate and opportunities, and we bring that into the platform later. That, of course, are different like line items of the service that NetNada provides to their clients, either group 1, 2, or 3, and their ambition level. Most clients, we also support with the data ingestion as part of our software fee, because we understand that there's a lot of questions that are unanswered that you only discover as you're going through that. And a person of one as a sustainability manager might not have the resources to do so. Last thing, there's now 15 days to go until Group 2 companies need to start to report. Starting to report means the data that happens, July 1st will enter your climate report, which means extreme weather events, a risk and opportunity, an emission generated after July 1st will now be included in your report. So be mindful that you need to start capturing those with the system ad hoc, but it starts now. Okay. Of course, you can do it retrospectively into the future. You might only buy in September or November or only next year. But the sooner you can do a dry run, understand your previous financial year, the easier it will be for everyone involved that have to approve the final words on the report. We're here to help. I'm an email away. I'll keep on sending emails via EDM. We have in-person events coming up. We are increasing the amount of videos we have on our YouTube, and we're going to try to make some of these topics way more concise. But again, we're here to help, and it's been really, really nice to answer all your questions over the past 5 sessions with ourselves and our partners. And if you do have any questions moving on, just feel free to reach out to me. Enjoy your Tuesday, and good luck with climate reporting. And it's long, it's hard, but it's easier than what people think. Thank you so much.